Hey guys, so welcome to the channel. This is going to be a full-on course on how to invest in stocks for beginners. It's going to be a completely free course, pretty long. But if you guys want to learn everything there is about investing, and you want a really good grasp on how to analyze a stock, how to set up a brokerage account, as well as my tips and techniques for making the most amount of money you can while investing, then this is the video for you. So, let's go over some of the things we're going to cover in this really in-depth course. The first thing we're going over is what the stock market is. We're also going to talk about what exactly are stocks, and how they actually make people money, right when you buy and you sell them. We'll also go into the different types of stocks that you can buy because it's not so simple. There are many different types of stocks you can buy. And it's definitely something really important that you should know before you start investing. We'll also go over the easiest way to open up a brokerage account. So, we'll be going through a couple of my favorite platforms to use, and how you can actually get some free stocks doing that as well. We'll go into the different types of accounts that you can use to buy and invest in stocks. A lot of people think there is only one type of stock account that you can use to buy stocks, but that's not true. There are so many different types. So we'll go over those. We'll go into timing the market, if it's a good thing to do, or if it's a bad thing to do. Best ways to do stock research. You guys, people have different ways of analyzing stocks and determining what stocks they want to buy, and there really isn't a completely right way to do it. But I will go into a couple of different types of ways that you can do your own stock research. And that brings us to key terms. These are terms that you definitely should know before investing, and they will help you actually evaluate different companies and be able to compare different companies with one another. We're going to the two top ways to make money with stocks, and then we'll also go into dealing with all the taxes that come with investing. Right? Anytime you buy something and sell it and realize a gain, or even when you realize a loss, there are tax implications, and you will want to know these things before you start investing. We'll also go into value versus momentum investing, and we'll also talk about Warren Buffett's principles of investing. Warren Buffett is one of the most prolific investors of our time, and it's really insightful to go over what his principles are when looking for companies to buy and sell. We'll talk about how long you should hold stocks for. It really depends on you and what your whole situation is. We'll go over the importance of investing early. This is super important. You'll see as I show you examples why it makes so much sense to invest as early as you can. So, if you guys haven't started investing and you're watching this video right now, that is why I really recommend watching this video all the way through. Get a good grasp on investing, and then open up your brokerage account today. Of course, we'll also talk about how much money you should invest. This really depends on your whole financial situation, but there are some rules that you can follow that allow you to invest a good chunk of your money, but not all of your money. That helps you diversify your holdings and not have all your eggs in one basket. Of course, we'll also talk about how you can do your own due diligence before investing in. The stock market is a marketplace where buyers and sellers can trade shares in companies. The companies that are traded in the stock market are all publicly traded companies, which are companies that outside retail investors can go ahead and buy shares of. The owners of the company dilute their personal equity in exchange for capital when they are traded in the stock market. An IPO, which stands for Initial Public Offering, is when a private company that is not yet publicly traded wants to be listed on the stock exchanges. An investment bank underwrites the IPO, buys up a ton of shares, and then sells those shares on the market for a fee based on the percentage of share price. In the United States, the stock market is regulated by the SEC, which stands for the Securities and Exchange Commission. Their whole job is to protect the public, promote fairness, and maintain efficient markets. There are currently 13 different exchanges in the US, with some of the big ones being the New York Stock Exchange, New York Stock Exchange, and the NASDAQ, which is heavily tech-focused. So now let's talk about the different types of investments that you can make. There are two main types of investments: debt and equity. Debt investments are when you lend money to a company or an organization, and they promise to pay you back with interest. This can include things like bonds or certificates of deposit, CDs. On the other hand, equity investments are when you buy a share of ownership in a company. This means that you own a portion of the company and are entitled to a share of the company's profits. This can include things like stocks or mutual funds. Now let's talk about the concept of risk versus reward. The higher the potential reward of an investment, the higher the risk. This means that if you want to invest in something with high potential returns, like a startup company, you have to be prepared to take on a higher level of risk. On the other hand, if you want to invest in something with lower risk, like a government bond, you will likely see lower returns. One thing to keep in mind is that diversification is key. This means spreading your money across different types of investments to reduce your overall risk. For example, you might invest in both stocks and bonds to diversify your portfolio. Finally, let's talk about the power of compounding. When you invest your money, you earn interest on your initial investment, but if you reinvest that interest, you earn interest on your interest. Over time, this can really add up, and your investment can grow significantly. So there you have it, Investing 101. Remember, investing is not a get-rich-quick scheme, but rather a long-term strategy for building wealth. By investing early and diversifying your portfolio, you can set yourself up for a comfortable retirement and financial security. Another benefit of exercise is that it can improve your mental health. Exercise has been shown to reduce symptoms of anxiety and depression, boost mood, and improve overall mental well-being. This is because when you exercise, your brain releases endorphins, which are chemicals that can create feelings of happiness and euphoria. Regular exercise has also been linked to better cognitive function, including improved memory and attention. It can even help protect against age-related cognitive decline. In addition to the physical and mental health benefits, exercise can also be a great way to socialize and connect with others. Joining a sports team or exercise group can help you meet new people and form friendships based on a shared interest in physical activity. Overall, incorporating regular exercise into your lifestyle can have numerous benefits for your physical and mental health, as well as your social well-being. Now let's talk about risk tolerance and investing. There's always going to be a small level of risk involved. So, you have your safest way of holding your money, which is in cash, but that's not going to grow and will lose value with inflation. Then you have bonds, which are probably the safest way to invest your money and get a small return. After bonds, you have index funds, which are tracking indexes and investing in a whole bunch of different companies. The risk is a bit less than buying individual stocks, which is our next one. This is a bit riskier because if a company goes out of business, you can lose all your money. Real estate is a bit riskier than stocks in general. There are a lot of things that can go wrong in real estate. Even riskier than real estate is trading in cryptocurrencies. There are different subcategories of each of these that are more or less risky than others. But this is the general risk profile of each of these types of investments. For most people that invest in stocks, I'd say that if you want to be safe, if you want to do long-term investing, then the Vanguard S&P 500 ETF BO is a really great choice. It's basically like investing in the US economy as a whole. With the S&P 500, these companies are historically seen to grow more than a total stock market index, because instead of investing in over 3,000 different companies, this index is only on the top 500 companies. Let's talk about the different types of brokerage accounts. There's not only one type of account that you can invest your money in. There are quite a few. We'll start with the taxable account. This is the most standard account. With this account, you're going to be paying tax. The cash account is basically letting you buy investments with money that you deposit into the account. With the margin account, this lets you borrow money from your broker to buy investments. This is a lot riskier and more advanced, so I'm not going to be talking about too much in this video. You also have retirement accounts, which are tax advantaged. So, you have the Roth IRA, traditional IRA, SEP, Solo 401k, 401k, and a lot more. With these types of accounts, you're only paying tax one time, so you're paying basically half the amount of taxes as a standard taxable account. In addition, GPT 3.5 is capable of performing a wide range of natural language tasks, such as text classification, sentiment analysis, language translation, and question answering. This is because it has been trained on a massive amount of diverse and high-quality text data, which enables it to learn patterns and relationships in language that can be applied to a variety of tasks. Furthermore, GPT 3.5 has an impressive ability to generate coherent and meaningful text, which has important implications for various applications, such as content creation, chatbots, and virtual assistants. It can generate high-quality human-like text that can be used to generate news articles, product descriptions, and even entire books. However, despite its impressive capabilities, GPT 3.5 still has limitations. For example, it can generate biased or offensive text, if it is trained on biased or offensive data. It also lacks common sense knowledge, and may generate nonsensical or illogical text in certain situations. Overall, GPT 3.5 represents a significant advancement in the field of natural language processing, and has the potential to revolutionize how we interact with language, and use it to solve real-world problems. If you want to start trading using Robinhood, you'll have to sign up and wait for your application to be approved. Once that's done, you can start funding your account and investing in stocks right away. The main dashboard will show you the value of your account, buying power, and portfolio, along with other features like articles, news, and popular stocks. You can even buy cryptocurrencies. If you want to purchase stocks, you can click on the stock you're interested in, choose whether you want to buy or sell shares, and make a market or limit order. For a limit order, you'll set a maximum price, and the app will purchase the stock only if it hits that price or lower. Furthermore, the text shows a demonstration of the app, with Microsoft stock as an example. The author clicks on the Microsoft screen and shows how you can buy or sell shares, view the price and other information, and set up a limit order. They also mention Weebly, another app for stock trading that they'll demonstrate later. Once you've created your Weebly account, the first thing you'll want to do is deposit funds into your account. You can do this by linking your bank account to your Weebly account and transferring money over. Once your account is funded, you can start trading. Weebly's dashboard looks a bit different than Robinhood's, but it still gives you all the necessary information about your portfolio. On the left-hand side of the screen, you'll see a navigation bar that allows you to access different parts of the platform. You can see your account balance, buying power, and portfolio performance. If you click on the trade button, you'll be taken to the trading screen. This is where you can buy and sell stocks. You can search for a specific stock using the search bar at the top of the screen, or you can browse stocks by category. Weebly offers a range of investment options, including stocks, ETFs, and options. To buy a stock, simply click on the stock's name, and then click on the trade button. You'll be prompted to enter the number of shares you want to buy and the price you want to pay. If the stock is currently trading at a higher price than what you're willing to pay, you can set a limit order. This means that you're only willing to buy the stock if the price drops to a certain level. Overall, Weebly is a great platform for both beginner and experienced traders. It offers a range of investment options and a user-friendly interface that makes it easy to trade stocks. Whether you're looking to make a few quick trades or you want to build a diversified portfolio, Weebly has everything you need to get started. When investing in the stock market, there are 3 different types of trades: market order, limit order, and stop order. A market order is when you buy or sell at the best available price in the current market, while a limit order is when you buy or sell at a specified price that you get to choose. The risk with a limit order is that it might not execute if the share price does not drop to the specified price. On the other hand, a stop order helps you buy or sell when the price moves past a specified price. To research stocks, there are several key metrics to understand. First is the stock price, which is the cost to purchase one share of that company. However, the stock price itself needs some context to determine how many shares there are in total. To get the market cap, you need to multiply the price by the number of shares in total. Another important metric is the 52-week low and high, which gives you an idea of where the share price currently stands. The trading volume is the quantity of shares that are traded during a given period. High volume means that a lot of people are trading it right now, and when paired with the trend of that price, it can give you an idea of whether the price will continue to go up or down. Beta is the stock's volatility in relation to the overall market, while the price-to-earnings ratio (PE ratio) is the price per share divided by the annual earnings per share. The PE ratio allows you to compare companies based on the price and how much money the business is earning. Finally, when investing in U.S. stocks, you will see your target allocation, your market value, and the things in it, such as FDI and SCHV. A sell limit means that it's only going to sell that stock at the specified price, which means it has to rise to that price. The risk with this is that it might not execute if the price keeps dropping down, and you would have come out ahead selling it at the current market price. The market and where it's heading. Some good sources of information for stock research include financial news websites, company financial statements, and investment research reports. It's also important to consider your own investment goals and risk tolerance when choosing stocks to invest in. Some stocks may offer higher potential returns, but also come with higher risks, while others may be more stable, but offer lower returns. Overall, investing in stocks can be a good way to grow your wealth over time, but it's important to do your research and make informed decisions. It's also a good idea to diversify your portfolio by investing in a variety of stocks across different industries and sectors to minimize risk. Let's say above 5 or 10. This could mean that maybe they aren't using their assets efficiently, so there should be a good balance. But if this number is under 1, this does mean that they are in sort of a precarious situation, where they have more liabilities than they have short-term actual assets. Now that we've gone through all these different types of metrics, I want to actually take you guys through a stock and put these to use. I have pulled up Apple stock, one of the most popular stocks out there with the highest market caps, and I'm on Yahoo Finance. If you come here, this is going to show you the current stock price, so what it's trading at. If you want to buy Apple right now, it'd be 123 and about 21 cents. It's always changing because the market is still open right now. Come down here and you can see the 52-week range. So in the last 52 weeks, it's been as low as $53.15, but as high as $145.09. That just gives you some context as to the current price. You can see the volume right here and the average volume. And then you have your market cap. So this is your current price multiplied by all the outstanding shares. And that's $2.069 trillion. So a large cap company, absolutely gigantic. You have your beta. So 1.25, meaning it is a little bit more volatile than the market. You have a PE ratio of 33.43. So just based off that number, it is a little bit overvalued if you look at it through a PE ratio standpoint. The earnings per share are 3.69. So that means that for each share that you have, they are earning 3.69 cents per year. The dividend yield is 0.68, meaning this is a very small mile diving stock. And for each share that you have, you're going to get 82 cents as a dividend as of right now. If you come here to the chart, you can see in the last year this is the price movement. So obviously a lot of growth, but a little bit of a correction right there in recent months. If you come here to statistics, this is where you can see a bunch of the other evaluation measures and metrics. Market cap right here. We talked about the PEG ratio, so this is the 5-year expected PEG ratio of 2.76. It is above 1, so technically it is overvalued. You have your price to sales and price book ratios right here. Price book ratio is 31.63, which is pretty high. So you know it is overvalued. Then we come down here to the profitability. So you have your profit margin as at 21.74, which is pretty good. You want to compare that to the industry. So this is in the tech industry. So I'm not sure what the average is, but you can do that research if you want. You have your return on equity, which we talked about. The row sitting at 82.09, so obviously very high, very good. You have your income statement stuff. If you want to look into that, you have your balance sheet. You can see that they have total cash of $76.83 billion. And the current ratio, which we did talk about, is 1.16. So just above 1, so that is a good sign. But it's not too high, meaning that they have just about 16 higher current assets, as they have current liabilities. Something I always like doing is coming back to the summary page and coming down here to the financials, to the analyst ratings, as well as the price targets of panic selling. In the long term, the stock market is shown to have a positive trend and has given great returns to investors who have stayed invested for a longer period of time. However, it is important to keep in mind that timing the market is not a guaranteed strategy for success. Predicting market movements is a difficult task, even for the most experienced investors. It requires extensive research, knowledge, and even a bit of luck. It is important to understand that even if you are able to predict the market movements correctly, it is not a guarantee that your investments will be profitable. Furthermore, timing the market often leads to emotional decision-making, which can be detrimental to your investment portfolio. When investors try to time the market, they often make impulsive decisions based on their emotions, rather than sound investment principles. This can lead to buying high and selling low, which is the exact opposite of what successful investors do. In conclusion, while timing the market may seem like an attractive strategy to achieve quick gains, it is not a reliable or sustainable way to invest. Instead, focus on a long-term investment strategy that is based on sound principles such as diversification, asset allocation, and periodic rebalancing. By doing so, you will be able to achieve your financial goals and build a successful investment portfolio. Investing and the tax implications that come with it. Investing in stocks can be great for making money in both ways, through appreciation and dividends. However, companies that pay out dividends tend to have slower growth than those that reinvest profits back into the company. On the other hand, stocks without dividends do not get taxed until they're sold, whereas dividends are a taxable event, regardless of whether the investor reinvests the money or uses it for their expenses. Investors should also consider the tax implications of selling stocks. Capital gains tax is owed if a stock is sold for more than the investor paid for it. Long-term capital gains occur when a stock is held for 1 year or longer, and they're taxed lower than short-term capital gains. Short-term capital gains are taxed as ordinary income and occur when a stock is sold before 1 year of holding it. In 2021, Long-term capital gains tax rates are 0, 15, and 20%, depending on the investor's income level. For short-term capital gains, tax brackets range from 10 to 37% for single filers. High earners should be aware that selling stocks held for under a year can massively increase the amount of taxes owed. Retirement accounts are important for saving money on taxes and preparing for retirement. The Roth IRA is an account that everyone should consider, especially if they expect to make more money later on. Withdrawing from your retirement accounts before age 59 and a half, there are some exceptions that allow you to withdraw penalty-free, such as for medical expenses or certain qualified education expenses. In addition to traditional and Roth IRAs, there are other tax-advantaged retirement accounts, such as 401ks, 403bs, and 457 plans, which are typically offered by employers. These plans allow you to contribute pre-tax dollars, reducing your taxable income in the year of contribution, and the investments grow tax-free until you withdraw the funds in retirement. Some employers also offer matching contributions, which is essentially free money that you should take advantage of if offered. It's important to note that there are contribution limits for these retirement accounts, and they can change year to year. For example, in 2021, the contribution limit for a traditional or Roth IRA is $6,000, or $7,000 if you're over 50 years old. The contribution limit for a 401k is $19,500, or $26,000 if you're over 50 years old. It's important to keep track of these limits and not overcontribute, as there can be penalties for doing so. Investing can be a powerful way to grow your wealth, but it's important to understand the potential risks and rewards. It's also important to consider taxes and take advantage of tax-advantaged retirement accounts. Finally, it's always a good idea to do your own research and seek the advice of a financial professional before making any investment decisions. Investing can be categorized into two types: value investing and growth investing. Value investors care about the fundamentals of the company and prefer undervalued companies that they believe will grow over time. On the other hand, growth investors focus on the future potential of the company, and they tend to invest in emerging industries, even if the company is overvalued. Investing early is important because of compound growth, and the earlier you invest, the more time your money has to grow. Even if you start investing small amounts of money, it can lead to a significant amount of growth in the future. The earlier you start investing, the more compound growth you can take advantage of. The amount of money you should invest depends on your situation, but it is recommended to invest money that you do not need to live. Another important aspect of self-improvement is developing skills that are in demand in the job market. This can include learning a new programming language, developing marketing skills, or improving your communication and leadership abilities. By investing in yourself and developing valuable skills, you can increase your earning potential and make yourself a more attractive candidate to potential employers. In addition to investing in yourself, it's also important to diversify your investments. This means spreading your money across different asset classes, such as stocks, bonds, real estate, and commodities. By diversifying your investments, you can reduce your risk and potentially increase your returns. One popular way to diversify your investments is through index funds. Index funds are a type of mutual fund that tracks a specific index, such as the S&P 500. By investing in an index fund, you can get exposure to a broad range of stocks and diversify your portfolio without having to pick individual stocks yourself. Finally, it's important to have a long-term investment strategy and stick to it. This means setting realistic goals, such as saving for retirement or a down payment on a house, and investing in a way that aligns with those goals. It also means avoiding the temptation to make short-term trades based on market fluctuations or trying to time the market. In conclusion, investing is an important tool for building wealth and achieving financial freedom. By educating yourself on the different types of investments and developing a long-term investment strategy, you can make your money work for you and increase your chances of achieving your financial goals. Remember, the key to successful investing is patience, discipline, and a willingness to learn and adapt over time. Part 2. The Step-by-Step Guide. This video will be like an extended course in itself, so I highly recommend that you watch it from beginning to end. Whether you're a beginner, intermediate trader, or stock investor, you're going to find nuggets of information all throughout this video. If you're not a fan of this kind of setup, or if you like the whiteboard better, the reason I'm doing it this way is because this is going to be a PowerPoint presentation mixed with live trading, mixed with me actually handwriting some stuff on this tablet here. So that's an easier way to teach you. Just that way you can see it live, and it'll be easier to connect the dots. So let's get right into it. This presentation here, I created. Obviously, it's presented by me. And if you don't know who I am, here are some quick credibility points on me. I've been investing in the stock market for 15 years now. I started when I was 18 years old. I have a finance degree and an entrepreneurship degree. I graduated in December of 2010, and I've been providing free value on YouTube since November of 2017. At the time of this recording, I think I have somewhere around 465,000 subscribers. So with that being said, let's get right into it. So, before we jump into investing in stocks, there are a few important things to understand first. The stock market can be volatile, meaning that prices can fluctuate rapidly and unpredictably. This can be scary for new investors, but it's important to remember that volatility is actually what creates opportunities for gains. Another key concept is diversification. It's not a good idea to put all your money into one stock, or even just a few stocks. Instead, you should diversify your portfolio by investing in a variety of stocks and other assets, like bonds and real estate. This can help reduce your risk and maximize your returns over the long term. So, with those things in mind, let's dive into the steps for how to invest in stocks as a beginner. Step 1. Open a brokerage account. In order to invest in stocks, you'll need to open a brokerage account. There are many different online brokers to choose from, each with their own strengths and weaknesses. Do your research and choose one that suits your needs and budget. Step 2. Fund your account. Once you've opened your account, you'll need to fund it with some money. You can start with as little as $50 or $100, but keep in mind that you'll need more if you want to build a substantial portfolio over time. Step 3. Decide on your investment strategy. There are many different investment strategies to choose from, but some of the most popular for beginners include index funds, exchange-traded funds, ETFs, and individual stocks. Each strategy has its own risks and potential rewards, so do your research and choose one that aligns with your goals and risk tolerance. Step 4. Research and choose your investments. Once you've decided on your strategy, it's time to research and choose your investments. Look for stocks or funds that have a solid track record of performance and good prospects for future growth. Step 5. Monitor your investments and adjust as necessary. Investing in stocks is not a set-it-and-forget-it endeavor. You'll need to monitor your investments regularly and make adjustments as necessary. This might mean selling stocks that are underperforming or buying more of those that are doing well. In conclusion, investing in stocks can be a powerful tool for building wealth over time. As a beginner, it's important to take the time to educate yourself on the basics of investing, including diversification and risk management. With a solid strategy and a bit of patience, you can start growing your wealth and achieving your financial goals. So, with all that being said, let's dive into the first step of investing in stocks for beginners. Step 1. Understand your goals. Before you start investing in stocks, it's important to understand your goals. What do you want to achieve? Are you investing for retirement? Are you saving up for a down payment on a house? Are you trying to build a long-term portfolio for your kids' college education? Understanding your goals will help you make smarter investment decisions. Step 2. Learn the basics. Before you start investing, it's important to learn the basics of the stock market. This includes understanding how stocks are priced, what drives stock prices, and how to read financial statements. You should also understand the difference between stocks, bonds, mutual funds, and other investment vehicles. Step 3. Choose a brokerage. Once you've learned the basics, it's time to choose a brokerage. There are a variety of different brokerages out there, each with their own pros and cons. Some brokerages offer commission-free trades, while others have a wider selection of investment options. Do your research and find a brokerage that fits your needs. Step 4. Open and fund your account. Once you've chosen a brokerage, it's time to open and fund your account. This is typically a straightforward process, but make sure you read and understand all the terms and conditions before you start investing. Step 5. Start investing. Finally, it's time to start investing. As a beginner, it's a good idea to start with a diversified portfolio of low-cost index funds or ETFs. This will help you minimize your risk, while still benefiting from the growth potential of the stock market. Remember, investing in stocks is a long-term game. Don't get caught up in the short-term ups and downs of the market. Stay focused on your goals and keep investing consistently over time. With patience and discipline, You can build long-term wealth through the stock market. Stocks are categorized based on market capitalization: large-cap stocks, mid-cap stocks, and small-cap stocks. Large-cap stocks have a market capitalization of over $10 billion, and they have a proven track record, offer dividends, and are the least risky. Mid-cap stocks have a market capitalization of between $2 billion and $10 billion, and they have a more established track record than small-cap stocks, and are often the target of mergers and acquisitions. Small-cap stocks have a market capitalization of between $300 million and $2 billion, are younger and are seeking aggressive growth, and are higher risk, and don't usually offer dividends. Stocks are also categorized by growth, income, and value. Growth stocks, such as Amazon and Facebook, have potential for high growth, but typically don't offer dividends, as they're reinvesting their earnings into improving their product or service line. Income stocks, such as 3M, Walmart, and Verizon, have a proven track record or business model, and consistently increase their dividends over time. Value stocks are perceived to be undervalued in the marketplace, and are typically seen as trading below their fundamentals. Finally, stocks are categorized into 11 broad-based sectors, which are areas of the economy in which businesses share a product or service. These sectors are energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. So now that we're understanding how stocks are categorized, we need to understand risk. Risk is the whole point of investing. This is how we're compensated as investors. We're compensated for the amount of risk that we take on. So, what is risk? Risk is the chance that your actual outcome will differ from your expected outcome. If I'm little Jimmy and I'm starting to invest in stocks, and I think the Tesla is going to go to $20,000 a share, and it ends up not doing that, that is the risk that I'm taking by going into that position. Risk includes the chance of losing some or all of your investment. Contrary to popular belief, stocks don't always go up. Okay, there are times when stocks do go down, and that is risk, and that's what you're being compensated for. So risk, as mentioned here, should be your reward. As investors, we're compensated for the level of risk we assume. So, for example, if I want to invest in a startup versus a savings account, I need to be compensated significantly higher for the amount of risk that I'm taking on for investing in a startup company, which has no proven model or track record, versus just putting my cash in a savings account, which is FDIC insured, and a much safer investment. So, there are different types of risk. Okay, there's a million different definitions and a million different types. But these 7 I've highlighted because I've come across them many times throughout my career, and also through my education. So, number 1 is market risk. This is basically the market as a whole. Number 2 is liquidity risk. This is the fact that, hey, I can't sell this investment. It's not liquid. Number 3 is concentration risk. You have too many eggs in one basket, meaning that you have way too many stocks that are similar, or you have all your money just in one stock, that kind of thing. Number 4 is credit risk. This means that the entity can't repay, so the company that you're investing in, for example, they can't pay off their credit, which causes them to liquidate certain things or causes them to go out of business. Okay, this also applies in bonds, which I'm not going to get into in this video. You have inflation risk, which is the loss of purchasing power. Number 6 is horizon risk. This is your investment time frame if it changes over time. Number 7 is foreign investment risk. This applies to foreign investments. Moving on. What are the types of stocks or equities, or what are we even buying here? Number 1 is individual stocks. When you think of individual stocks, you're thinking of companies such as Amazon, Apple, Tesla, etc. Invest in and achieve your goals over time. Some of the cons are that you don't have any control over the holdings, you're not picking individual stocks, and you're basically just accepting what that manager or that passive fund is giving you. You have a lack of downside protection, meaning that if stocks take a plunge, this isn't a hedge fund, meaning you're not hedged to help prevent any downside. ETFs are simply a basket of stocks, again to mimic a certain market sector that trades on an exchange. Some of the pros to this are that you have access to many stocks. They have extremely low expense ratios, again, because they're either passively or actively managed, which actually passes the savings on down to you. REITs, which are real estate investment trusts, have actually allowed these companies to go public and make them very liquid, and actually give the masses access to their balance sheets. So you get stable cash flow through dividends, because REITs have to pay out 90% of the income they produce, and historically commercial real estate has been a sound asset class. Okay, So the next ratio we're going to take a look at is the PEG ratio. The PEG ratio is simply a valuation metric that takes the company's share price to its earnings per share growth. This gives us the relative value of a company's stock value, factoring in growth. So if we look at the formula should be the price divided by the earnings per share, which we know both those things we just calculated for PE ratio, divided by earnings per share growth. The earnings per share growth is an estimate, so if we take a look at Finviz, we typically use the next 5 years for the long-term annual growth estimate that analysts predict. And we can see here that it's 14.55. If I want to show you guys how to do this, let me write this down. Remember that our formula is simply the share price, so let's just use 225.50 for easy numbers, divided by the earnings per share, which was 6.2 in our last example. And we're going to have the earnings per share growth, which was 14.55%. So this should get us a number. If we put this all into the calculator, we can use 225.5 divided by 6.2. That gives us 36.37, which was our PE ratio, divided by 14.55. That gives us 2.49. If we take a look at the PEG ratio, the answer is right here, 2.47. So, that's PEG ratio. The next ratio is the price-to-book ratio. This is also a valuation ratio. The price-to-book ratio is a company's market cap to its book value. So, this compares the cost of a stock to the value of its equity if the company was sold today. So, the formula for this is the market price per share divided by book value per share. Book value is simply total assets minus total liabilities, divided by shares outstanding. And we're shooting for a healthy PB ratio of 3 or lower. If I go to Finviz, we can see here that the PB ratio is 13.66. So, this basically means that the stock is trading 13.6 times what Microsoft's total assets are, or the book value of its assets, which is really high. The next metric is return on assets, ROA. ROA is a profitability ratio. It shows how profitable a company is compared to its assets. It gives an investor an idea as to how efficient a company's management is running the assets to generate earnings. The formula is net income divided by total assets, and a healthy ROA ratio is 5% or higher. On Finviz, you can see right in the middle of the screen, in the middle column, the ROA is 16.2%. Which is very good. The next ratio is return on equity, ROE. This is another profitability ratio. Return on equity is simply a measure of how efficient a company is at generating profits. This gives an investor an idea as to the profitability of a company in relation to its stockholders' equity. The formula here is simply net income divided by total assets. If we look at this, you can see that Microsoft's ROE is 40.7%. Which is crazy high. A healthy ROE ratio is subjective. These ratios are completely dependent on the type of company, the type of business, and other factors. Typically, these numbers come from value investing historically. But you can see here that it's all subjective. Okay, this is a chart. It's not the most technical chart in the world, but basically, if I choose to expand this, I can get into something a little bit more technical. But that's not the point of this video. I'm actually going to use this just to kind of prove my point here. Right now, we're looking at a one-day chart of Microsoft, so this means that anything that's going on from the beginning of trading, which is Monday through Friday, 9 a.m. Eastern Standard Time, all the way to the end of the day, which we're not at just yet. It's 3:48 at the time of this recording, so you can see that it went up and down, but it stayed somewhere right around, let's call it $225 per share, as we've been using in our example. So you can actually zoom out. You can go to a 1-week chart. You can go to a 1-month chart. You can go to a 3-month chart. You can go to a 1-year chart or a 5-year chart. Most charts or most brokerages will actually let you go to all time, meaning that from when the company IPO'd, which was the initial public offering, all the way until current time. In the past 5 years, if you invested in Robinhood, you would be up a whopping 306%. That means that you basically started January 1st, 2016. When it was valued at $55.48 per share. 5 years later, you basically went up to $169 per share, which gets you at $225 per share, which is a crazy return. Now imagine if you did this over many years compounding on the dividends that Microsoft offers. So, what we're going to show you here is how to actually buy a stock. If you look at the top right corner up here, you have buy and sell, and it gives you the ticker symbol of MSFT. So, if I go to buy Microsoft, I can either invest a dollar amount or a shares amount. There's different schools of thoughts on this. Now, with fractional shares, you can actually invest any amount of money. and it will let you buy a fraction of this $225.18 or this fraction of the share price. That is called fractional shares. To give you an example, if I wanted to buy 1 share of Microsoft, it would cost me $225.13. So, how do we arrive at this price? How does this price even come into existence? Remember that this is a market. We have a bid and an ask. If you click on the question mark here or click on market price, this will open up this window right here. You can see what the last sale of Microsoft was. It was at $225.14. There's always going to be a bid, and there's always going to be an ask. The bid is what bidders are willing to pay for Microsoft or 1 share of Microsoft. The ask is what people are asking for, the sellers of it. So, remember, buyer-seller, it's a marketplace. You have to come somewhere in the middle and come to an agreement. People can unload their shares for less or for more, but you may or may not have buyers, and at that point, the market isn't efficient. If I wanted to buy 1.5 shares, you can see here that my estimated cost is going to go up. The cool thing is that you can go out to a bunch of different decimal places, as long as it lets you buy it. How to buy and sell stocks, and how it can affect taxes. To start, we need to understand that when you buy a stock, you're actually buying ownership in a company. The value of that company then affects the value of the stock. To make a profit, you need to sell the stock at a higher price than what you bought it for. There are 2 ways to buy a stock: a market order and a limit order. A market order means you will sell the stock at the current market price. A limit order means you will sell the stock at a specific price. For beginners, it's recommended to start with a limit order, and then set it up for a good for day or good till cancelled. If you want to sell the stock at the market price, then you'll do a market order. To sell, just click review order and sell. It's important to note that selling a stock can result in a capital gain or a capital loss. A capital gain is when you sold for more than what you bought it for. A capital loss is when you sold for less than what you bought it for. For short-term capital gains or losses, this means you bought and sold the stock within 1 year. This counts as regular taxable income, so your tax brackets can be anywhere depending on your income. For long-term capital gains or losses, this means you held the stock for longer than 1 year. Capital gains tax is taxed differently and typically more favorably, depending on your income tax bracket. That concludes the discussion about buying and selling stocks, and how it can affect taxes. Remember, it's essential to learn and understand the basics of investing, including how to read the balance sheet, cash flow statement, and income statement. If you want to download the presentation, you can do that from the link in the description below, or the pinned comment of the video. There are also free stocks available when you sign up for Robinhood, Webull, and M1 Finance, as well as a free training course available in the description. Also, I have a free ebook called The Beginner's Guide to Investing that you can download for free in the link in the description below. This ebook covers everything from the basics of investing to more advanced concepts, and it's a great resource for beginners who are just starting out. Finally, I just want to reiterate the importance of doing your own research and making informed investment decisions. The stock market can be a volatile and unpredictable place, and there are always risks involved. However, with the right knowledge and tools, you can minimize those risks and make smart investment decisions that will help you grow your wealth over time. Thank you for watching this presentation, and I hope you found it informative and helpful. If you have any questions or comments, feel free to leave them in the comment section below, and I'll do my best to answer them. Good luck with your investments. Part 3. How to invest your savings for both short and long-term goals. Investing your savings can be a daunting task, especially if you are new to the world of finance. But with the right guidance, you can create a solid investment plan that will help you achieve your short and long-term goals. In this article, we will discuss how to invest your savings for both short and long-term goals. We will provide you with a step-by-step guide on how to create an investment plan that suits your needs and risk tolerance. Before we dive into the details, it's important to understand the difference between short and long-term investments. Short-term investments are investments that you plan to hold for a period of 1 year or less. These investments are usually low risk and provide quick returns. Examples of short-term investments include savings accounts, money market accounts, and certificates of deposit (CDs). Long-term investments, on the other hand, are investments that you plan to hold for more than 1 year. These investments are generally higher risk, but offer the potential for higher returns over the long run. Examples of long-term investments include stocks, bonds, mutual funds, and real estate. Now that we have a basic understanding of short and long-term investments, let's discuss how to invest your savings for both types of goals. Short-term investments. When it comes to short-term investments, safety and liquidity are key. You want to invest your money in assets that are safe and easy to access in case of an emergency. Here are some short-term investment options to consider. High-yield savings accounts. High-yield savings accounts are a great option for short-term investments. They offer higher interest rates than traditional savings accounts and are FDIC insured. This means that your money is safe and protected up to $250,000 per depositor per insured bank for each account ownership category. Money market accounts. Money market accounts are similar to savings accounts, but they typically offer higher interest rates. These accounts are FDIC insured and offer easy access to your money. Certificates of deposit, CDs. Certificates of deposit, CDs, are time-bound savings accounts that offer higher interest rates than regular savings accounts. You can choose the term of your CD, which can range from a few months to several years. CDs are FDIC insured and provide a guaranteed return on your investment. Treasury bills. Treasury bills are short-term debt securities issued by the U.S. government. They are considered one of the safest investments in the world and offer low risk and easy liquidity. Treasury bills are sold at a discount and mature at face value. Long-term investments. When it comes to long-term investments, you need to consider your risk tolerance, investment goals, and time horizon. Here are some long-term investment options to consider. Stocks. Stocks are one of the most popular long-term investment options. They offer the potential for high returns, but also come with higher risks. It's important to diversify your portfolio by investing in a variety of stocks from different industries and sectors. Bonds. Bonds are debt securities issued by corporations or governments. They offer a fixed rate of return and are generally considered a safer investment than stocks. Bonds are classified by their credit rating, which indicates the issuer's creditworthiness. Mutual funds. Mutual funds are a popular investment option for beginners. They are professionally managed and offer diversification by investing in a variety of stocks and bonds. Mutual funds have different investment objectives, so it's important to choose one that aligns with your investment goals. Real estate. Real estate can be a good long-term investment option for those who are willing to put in the time and effort. You can invest in real estate by buying a rental property, flipping houses, or investing in real estate. Investment options such as exchange-traded funds, ETFs, and index funds can also be considered for long-term investments. These funds are designed to track the performance of a particular market index or sector, and are a popular choice for passive investors. Now that we have discussed some short and long-term investment options, let's dive into the steps you should take when creating an investment plan. Step 1. Determine your investment goals. The first step in creating an investment plan is to determine your investment goals. Ask yourself, what do you want to achieve with your investments? Do you want to save for a down payment on a house, retirement, or your children's education? Once you have identified your investment goals, you can move on to the next step. Step 2. Assess your risk tolerance. Your risk tolerance is the level of risk you are willing to take on when investing. It's important to be honest with yourself about your risk tolerance, because it will help you choose the right investments for your portfolio. If you are risk-averse, you may want to consider investing in lower-risk assets, such as bonds or high-yield savings accounts. If you are willing to take on more risk, you may want to consider investing in stocks or real estate. Step 3. Determine your investment horizon. Your investment horizon is the length of time you plan to hold your investments. If you have a short-term investment horizon, you may want to consider investing in low-risk assets that provide quick returns. If you have a long-term investment horizon, you may want to consider investing in higher-risk assets that offer the potential for higher returns over time. Step 4. Create a diversified portfolio. Diversification is the key to managing risk in your investment portfolio. It involves spreading your investments across different asset classes and industries to minimize the impact of any one investment on your overall portfolio. By diversifying your portfolio, you can reduce your risk and increase your potential for returns. Step 5. Monitor and adjust your portfolio. Investing is not a one-time event. It's important to monitor your portfolio regularly and make adjustments as needed. This may involve rebalancing your portfolio to maintain your desired asset allocation or selling investments that are no longer aligned with your investment goals. In conclusion, investing your savings can be a great way to achieve your short and long-term financial goals. By following these steps and investing in a diversified portfolio of assets that align with your investment goals, risk tolerance, and investment horizon, you can create a solid investment plan that will help you achieve your financial dreams. Remember to monitor your portfolio regularly and make adjustments as needed to ensure that you stay on track towards achieving your investment goals. Part 4. Saving and investing tips for all ages. As we move through different stages of life, our financial priorities and goals change. However, one thing that remains constant is the importance of saving and investing for our future. Whether you're just starting out or getting closer to retirement, here are 10 saving and investing tips for all ages. Tip number 1. Start saving early. It's never too early to start saving for your future. In fact, the earlier you start, the better off you'll be in the long run. Even small amounts of savings can add up over time, thanks to the power of compound interest. The key is to make saving a habit and to stick with it. Tip number 2. Build an emergency fund. Unexpected expenses can arise at any time, so it's important to have an emergency fund to fall back on. Aim to save 3 to 6 months worth of living expenses in a separate account that's easily accessible in case of an emergency. Tip number 3. Maximize your employer's retirement plan. If your employer offers a retirement plan such as a 401k or 403b, take advantage of it. These plans allow you to save for retirement on a tax-deferred basis, which means you won't pay taxes on the money you contribute until you withdraw it in retirement. If your employer offers a matching contribution, be sure to contribute at least enough to get the full match. Tip number 4. Consider a Roth IRA. If you don't have access to a retirement plan through your employer, consider opening a Roth IRA. With a Roth IRA, you contribute after tax dollars, but your earnings grow tax-free, and withdrawals in retirement are also tax-free. Roth IRAs are a great option for young investors who expect to be in a higher tax bracket in retirement. Tip number 5. Invest for the long term. Investing is a long-term game, so it's important to have a long-term perspective. Don't try to time the market or chase after hot stocks. Instead, focus on building a diversified portfolio of low-cost index funds and ETFs that align with your risk tolerance and investment goals. Tip number 6. Keep fees low. Fees can eat into your investment returns over time, so it's important to keep them low. Look for investments with low expense ratios and avoid high-fee mutual funds or financial advisors who charge high fees. Tip number 7. Rebalance your portfolio. Over time, your investment portfolio may become unbalanced as some assets perform better than others. It's important to rebalance your portfolio periodically to ensure that you maintain your desired asset allocation and risk level. Tip number 8. Don't overlook bonds. While stocks may offer the potential for higher returns, they also come with higher risk. Bonds can help balance out the risk in your portfolio and provide a steady stream of income. Consider investing in a mix of stocks and bonds that aligns with your risk tolerance and investment goals. Tip number 9. Keep your emotions in check. Investing can be an emotional rollercoaster, especially during times of market volatility. It's important to keep your emotions in check and stick with your long-term investment plan. Don't make rash decisions based on fear or greed. Tip number 10. Get professional advice when needed. While it's possible to manage your own investments, there may be times when you need professional advice. Consider working with a fee-only financial planner who can help you create a comprehensive financial plan that aligns with your goals and risk tolerance. In conclusion, saving and investing for your future is a critical component of financial success at any age. By starting early, building an emergency fund, maximizing your retirement savings, investing for the long term, keeping fees low, rebalancing your portfolio, not overlooking bonds, keeping your emotions in check, and seeking professional advice when needed, you can set yourself up for a more secure financial future. Here are a few more tips to consider. Tip number 11. Keep an eye on your credit score. Your credit score can impact your ability to borrow money, secure loans, and even rent an apartment. It's important to monitor your credit score regularly and take steps to improve it if necessary. Pay your bills on time, keep your credit utilization low, and check your credit report for errors. Tip number 12. Consider alternative investments. While stocks and bonds are the most traditional forms of investing, there are other options to consider as well. For example, real estate, commodities, and cryptocurrencies are all alternative investments that may offer diversification benefits. However, these investments also come with their own unique risks and should be approached with caution. Tip number 13. Stay educated. The world of investing is constantly changing, so it's important to stay educated and informed. Read financial news, attend investing seminars, and listen to podcasts or watch videos from trusted sources. By staying up to date on market trends and investment strategies, you can make more informed decisions about your money. Tip number 14. Don't neglect your health. While it may not seem directly related to investing, Taking care of your physical and mental health can have a big impact on your financial well-being. Healthcare costs can be a major expense in retirement, so staying healthy can help reduce these costs. Additionally, maintaining a healthy lifestyle can lead to better job performance, higher income, and more opportunities for career advancement. Tip number 15. Create a will and estate plan. No one likes to think about their own mortality, but creating a will and estate plan is an important step in protecting your assets and ensuring your wishes are carried out after you're gone. Consult with an estate planning attorney to create a comprehensive plan that includes a will, power of attorney, and health care directive. By following these saving and investing tips, you can set yourself up for a more secure financial future. Remember, investing is a long-term game and requires patience, discipline, and a willingness to learn. Start early, stay the course, and seek professional advice when needed. Your future self will thank you for it. Tip number 16. Have a backup plan. No matter how carefully you plan and save, unexpected events can always arise. That's why it's important to have a backup plan in place. Consider building an emergency fund to cover unexpected expenses, such as a car repair or medical bill. It's also a good idea to have disability and life insurance policies to protect yourself and your family in the event of an unexpected injury or death. Tip number 17. Start saving for retirement early. One of the most important investments you can make is in your own retirement. The earlier you start saving, the more time your money has to grow. Consider opening a retirement account, such as a 401k or IRA, and make regular contributions. If your employer offers a matching contribution, be sure to take advantage of it. And if you're self-employed, consider a solo 401k or SEP IRA. Tip number 18. Diversify your portfolio. Diversification is key to a successful investment strategy. Rather than putting all of your money in one stock or asset class, spread your investments across a variety of different securities. This can help minimize your risk and potentially increase your returns. Consider investing in mutual funds or exchange-traded funds, ETFs, that offer broad exposure to different asset classes. Tip number 19. Avoid emotional investing. It's natural to feel emotional about your investments, especially when the market experiences volatility. However, making investment decisions based on fear or greed can lead to poor decision-making and ultimately hurt your portfolio. Stay disciplined and avoid making impulsive decisions based on short-term market fluctuations. Tip number 20. Get professional advice. Investing can be complex and overwhelming, especially for those who are new to the game. Consider working with a financial advisor or planner who can help you create a personalized investment strategy based on your individual goals and risk tolerance. A professional can also provide guidance and support during times of market volatility, helping you stay on track towards your long-term goals. By following these saving and investing tips, you can build a strong financial foundation for yourself and your family. Remember, investing is a journey, not a destination, and it requires ongoing education and discipline. But with the right mindset and approach, anyone can become a successful investor. Tip number 21. Avoid high fees and expenses. When investing, it's important to pay attention to the fees and expenses associated with different investment options. High fees can eat into your returns and potentially derail your investment strategy. Look for low-cost options, such as index funds or ETFs, and avoid actively managed funds with high expense ratios. Tip number 22. Stay the course. Market fluctuations can be nerve-wracking, but it's important to remember that investing is a long-term game. Avoid making knee-jerk reactions to short-term market movements and stay committed to your investment strategy. Rebalance your portfolio periodically to maintain your desired asset allocation, but don't make drastic changes based on fear or greed. Tip number 23. Consider tax implications. Taxes can have a big impact on your investment returns, so it's important to consider the tax implications of your investment decisions. Consider investing in tax-advantaged accounts, such as a 401k or IRA, and avoid making frequent trades that can trigger capital gains taxes. Consult with a tax professional if you're unsure about the tax implications of a particular investment. Tip number 24. Avoid speculation. Investing and speculation are two different things. Investing involves purchasing securities with the intention of holding them for the long term and generating returns through price appreciation or dividends. Speculation, on the other hand, involves taking on excessive risk in the hopes of making a quick profit. Avoid speculating with your investments and stick to a disciplined, long-term approach. Tip number 25. Stay patient. Investing can be frustrating at times, especially during periods of market volatility. But it's important to stay patient and stick to your investment plan. Remember that investing is a long-term game, and that short-term market movements are often unpredictable. By staying patient and disciplined, you can weather market fluctuations and achieve your long-term financial goals. By incorporating these additional tips into your saving and investing strategy, you can further improve your chances of achieving financial success. Whether you're just starting out or have been investing for years, there's always room for improvement and growth. Certainly, here are some more insights from the Bankrate article. Tip number 26. Invest in yourself. Investing in yourself can be one of the best investments you make. Consider taking courses, attending conferences, or getting additional certifications or degrees that can help you increase your earning potential. The more valuable you are in the job market, the more opportunities you'll have to earn and save money. Tip number 27. Set realistic goals. When it comes to investing, it's important to set realistic goals. While it's tempting to shoot for the stars and try to get rich quick, that approach often leads to disappointment and frustration. Instead, focus on setting achievable goals that align with your values and priorities. Consider working with a financial planner to help you set and achieve your investment goals. Tip number 28. Don't time the market. Trying to time the market is a losing game. Even professional investors struggle to predict the future movements of the stock market. Instead of trying to time the market, focus on developing a long-term investment strategy that aligns with your goals and risk tolerance. Stay disciplined and avoid making impulsive decisions based on short-term market fluctuations. Tip number 29. Be prepared for inflation. Inflation can erode the value of your savings over time. That's why it's important to consider the impact of inflation on your investment strategy. Look for investments that have historically provided a hedge against inflation, such as stocks or real estate. Consider incorporating inflation-protected securities, such as TIPS, into your portfolio. Tip number 30. Stay educated. Investing can be complex and ever-changing, which is why it's important to stay educated about the latest trends and strategies. Subscribe to financial publications, attend seminars or workshops, or join an investment club to stay informed and up to date. The more you know about investing, the better equipped you'll be to make informed decisions and achieve your financial goals. By incorporating these additional tips into your saving and investing strategy, you can further improve your chances of achieving financial success. Remember, investing is a journey, not a destination, and it requires ongoing education, discipline, and patience. But with the right mindset and approach, anyone can become a successful investor.